Hello everyone, welcome to past paper discussion sessions for advanced taxation exam. I'm your tutor Owais Mirchawala, and in our today's class we will be starting discussion on advanced taxation exam paper of September December 2024 exam attempt. In our today's class we will be discussing question number 1 of this exam paper. These past paper revision sessions are really important in your finalization phase of exam preparation. In this series of past paper discussion sessions, we will be discussing almost 8 complete attempt exam papers, which will give you an idea that how you have to deal with all of the topics together in your actual examination. Further, it will also give you an idea about the time management skill, which is the most important in the professional level exam. Now, once this series of 8 complete attempt past paper discussion sessions is done, then I will be providing with 3 mock exams to all of you guys, which you have to attempt and send me for marking and feedback. This strategy of mine of past paper revision sessions and then mock exams have been successful a lot for my students. And this is the reason why more than 35 of my students have secured nationwide positions in this exam of advanced taxation. So, in our today's class, we will be looking at the question number 1. Along with this, we will also be referring my summary notes in which I have summarized the entire course of advanced taxation in just 56 pages. Whatever topic will be coming in the question, we will be referring its relevant rules through the summary notes. It is a very good function of find. We can find any rule, anything which we want to refer while we are discussing this past paper. Our approach will be very detailed during our today's class. We'll read this entire question, including the introduction, all the exhibits, and the requirement. Then we will be discussing the points which we have to include in our answer. Then at the end, we will be drafting the complete answer in our today's class. So it will be a detailed class, and your patience and concentration throughout the class will be really important. Okay, so let's start with it. Let's start with the reading of the introduction. Your patience and concentration will be very important because when we read it, sometimes it's boring for the students, but it's very important that you read the question carefully so that you can pick up the maximum possible data. I will be solving the question like you will be doing in your actual examination. Like we will be thinking the points, we will be drafting the answer, and that entire journey we will be going through. Okay, so let's look at it. I want you all to listen to me very carefully. Now, you should assume that today's date is 1st June 2024. You are a tax senior working for a firm of accountants. Your manager has asked you to carry out some works in relation to Lucia and her son Ulf, who are new clients of your firm. In addition to some ethical considerations which have been raised by your manager, advice is required in respect of the sale of an asset that was acquired as the result of a gift, the potential taxes borne where profits are extracted from a company, the reliefs available in respect of a trading loss of an unincorporated business. See, this is an introduction screen of the question, so the examiner is just giving you a brief that what he will be asking during this entire question. It's just an introduction. He's just giving you in brief that these all will be the requirements which you have to deal with. The value added tax capital goods scheme, the VAT implications of purchasing components from overseas, and the inheritance tax payable in respect of a dead state. The following exhibits available on the left-hand side of the screen provides information relevant to the question. These all exhibits. Lucia, email from manager. Lucia's tax affair, letter from Lucia. Legacy received by Ulf, schedule from manager, and work to be carried out, an email from manager. So these all are the exhibits which we'll be reading. We'll be picking up the entire data, and then we'll be actually drafting the answer. The information should be used to answer the question requirements within your chosen response options. You all know that there are 2 response options. One is word processor, in which we do the actual drafting, and then there is a spreadsheet which can be used for the calculation purposes. Okay, So now let's look at each of the exhibit. Let's read it. See, when you are reading the question for the first time, I always say to my students that your patience is very important. What students do is that when they are reading the question for the first time, they jump to conclusions that the question is difficult. Why are we not able to draft anything? Our 15 minutes are wasted in reading. See, that's part of the journey. It will happen always. Your reading of the question is very important. You pick up the maximum possible data, you identify the data, and then that all is then helpful when you actually draft the answer. Okay? Extracts from an email from your manager dated 1st June 24. Lucia and her adult son Alf are new clients of our firm. Lucia had been unhappy at the way our previous tax advisors were critical of the technical competence of other local accountancy firms. The previous tax advisor used to criticize other firms, which wasn't very good in view of Lucia, and obviously it's not good. It's against professional behavior that you undermine other service provider. However, she finally made the decision to change the advisor because the previous advisors falsely claimed to have submitted documents relating to her personal tax affairs to HM Revenue and Customs when in reality they had lost them. We will be advising Lucia on the personal and business tax affairs and Alf on a legacy he has received. So apparently in the exhibit 1, he is referred an ethical issue where previous tax advisors used to criticize other service providers and the previous tax advisor falsely claimed that they submitted a document when they in reality didn't submitted it. So apparently this is something relating to ethics. Obviously, as we'll move forward, we'll find further inquiry in relation to it. Let's move forward. As I told you, when you read the question for the first time, it's very important that you read it with patience. You are just identifying the maximum possible data. Now, extract from a letter from Lucia dated 1st June 24. Following our recent discussions, I've decided to incorporate my business. I will transfer all of my business assets to LRA Limited, a newly formed company, on 1st April 25. In exchange, I will receive ordinary shares in LRA Limited as consideration and will own the whole of the company. So he will transfer his business and will get 100% shares. So it's a simple situation of incorporation relief. You have confirmed that incorporation relief will be available such that this transaction will not give rise to immediate capital gain tax liability. It is my intention to own and manage the company for the foreseeable future. I look forward to receiving your advice on my personal tax affairs and the future activities of the company, and I set out below the information requested. So, he is giving us an introduction of the scenario. In the first exhibit, you referred as some ethical issue. Now you referred as the situation that, as per our advice, they have shifted their unincorporated business to the structure of company. Still, no issue has been discovered on which we have to do the discussion. So let's read with patience. My personal tax affairs. Disposal of waterside cottage. The only chargeable asset I have previously disposed is a house, waterside cottage, which I sold on 1st January 2024 for £229,000. My mother, Mika, gave the house to me on 1st November 23 when its market value was 225,000. We submitted a joint claim for gift holdover relief in respect of this gift. My mother had always rented out the house as a qualifying furnished holiday accommodation, but I decided to sell it in order to finance the expansion of my business. I did not live in the house at any time. My mother inherited Waterside Cottage from her uncle who had purchased it for £130,000 on 1st November 2007. On 1st May 15, when my mother inherited the house, it had a probate value of 216,000. We will obviously solve it at a later phase, but let me brief you the entire treatment verbally. See, when he's selling this house for 229,000, the disposal proceed will be 229. Now, when the cost will be concerned, when he got the house from mother, its value was 225. But since they submitted a claim of gift holdover relief, so the base cost must have reduced. Okay. Now, when we talk about her mother, when she gifted, for her mother, the disposal proceed was 225. And the mother got the house when its value was 216. When we inherit anything, we get it at probate value. Probate value means market value on death. So his mother must have got the house for a value of 216. So when her mother gifted, at that time, 225 minus 216. 225 minus 216. A gain of 9,000 must have arisen. When the mother gifted this house at that time, the value was 225. The cost for mother was 216. We do not have to look at the cost for uncle because mother got the house on death, inherited, the probate value. So for this gain of 9,000, gift holdover relief was claimed. Okay. Now when we claim gift holdover relief, this reduces the base cost. So 225,000 minus 9,000, the base cost was 216,000 when we got this property. And now when we are selling it for 229, so 216 minus 229, the gain will be of 13,000. I will repeat it again. When we are selling it for 229, the disposal proceed is 229 less the cost. Now what's the cost? What is the cost? We got it for a value of 225. But gift holdover relief was claimed, so the gain must have been deferred. So now what was the gain of the donor who gifted us? So the donor was mother, his mom, Mika. She gifted. So for her, the gain was 225 minus 216. So that 9,000 gain was deferred through gift holdover relief, which must have reduced the base cost, and that will then impact the current gain. Obviously, when we will be doing the calculation, it will get crystal clear. There is nothing to worry. Now let's move forward. Results of my unincorporated business. Now, tax year 22-23, there was a trading profit of 18,000. 23-24, there was a profit of 30,000. In 24-25, there was a loss of 40,000. Now, this was his unincorporated business, which he's converting into the structure of company from 1st April 25. He is converting his unincorporated business to the structure of company. My business is my only source of income. LRA Limited plans for the year ending 31st March 26. LRA Limited will purchase new business premises at a cost of £290,000 plus value added tax. One of the room in this building representing 15% will be rented out to an unconnected business. The arrangement will continue for no more than 4 years as I expect LRA Limited to then need the whole of the building. So 85% of the building will be used for taxable purpose. 15% will be rented out. So the 15% portion which we are renting out, that's an exempt use and we won't be able to recover the VAT in relation to that. After 4 years, the taxable use will increase to 100%. I hope you all remember the rules of land and building, the rules of capital goods scheme, that the change in taxable use is monitored for a period of 10 years. So when we'll be solving it, we'll be getting a better idea. LRA Limited will investigate the possibility of purchasing product components from a supplier based in the country of Palmyra. This would replace an existing supplier situated in UK. So basically, we will be importing the material. Okay, we will be importing the material. So from the VAT perspective, when you import anything, you pay VAT on it. But when you are VAT registered businesses, you can later on recover that. Okay, so rules relating to land and building and then overseas transactions. If you don't remember anything, you can simply go to summary notes, write value added tax, You can go in the relevant rules of value-added tax. You can find the rules of land and building. Okay. You can find the rules in relation to capital goods scheme that when a land and building is worth more than 250,000, you monitor the taxable use for 10 years. You can look at the rules for overseas transaction. For imports, the VAT is payable by the purchaser, like they are importing it. But later on, you can recover the VAT if you are a tax registered business. Okay, a VAT registered business, obviously, when you are making the taxable supplies. Let's move further. We are just reading the question, trying to identify maximum possible data. Now, schedule from your manager dated 1st June 24, legacy received by Ulf. Background. Ulf's aunt, Gunella, died on 1st March 24. She left the whole of her estate to Ulf. Gunella was a widow whose husband Pietro had died on 1st December 20. Both Gunella and Pietro had always been domiciled in the country of Boruna and had never been deemed UK domicile. On his death, Pietro left the whole of his estate to Gunella. He had not made any transfers during his lifetime. Now, Pietro was the husband of Gunella, husband transferring entire death estate to wife. So everything is exempt. Okay. And when husband transfers the entire thing to wife, when everything is an exempt transfer, the nil rate band also gets transferred. I hope you all remember the rules of transfer of NRB. Since Pietro left the whole of state to wife, Gunella, and has not made any transfers during his lifetime, so his nil rate band will also get transferred. You should note that there is no inheritance tax in Baruna and there is no double tax treaty between UK and Baruna. Gunella's death state and lifetime gifts. The market value of the assets owned by Gunella, home situated in Baruna, rental property situated in Baruna, farmland situated in UK. See, you need to understand here that Gunella and Pietro had been domiciled in Baruna and they had never been deemed domiciled in UK. When you are not a UK domicile holder, listen to me, when you are not a UK domicile holder, you only pay IHT on your UK assets, no IHT on overseas assets. When you are not a UK domicile holder, when you are not a UK domicile holder, you only pay UK IHT on UK assets, no IHT on overseas assets. Like on home situated in Baruna, no UK IHT. Rental property situated in Baruna, no UK IHT. You can refer the rules of overseas IHT. You can refer the rules. If a person is UK domicile holder, then he has to pay UK IHT on worldwide assets. But if he's non-UK domicile holder, then UK IHT on UK assets only. So the UK assets is the farmland situated in UK 470,000 and account in UK 68,000. All of the assets are of Boruna. No IHT on those assets of Boruna. If you are not a UK domicile holder, you only pay UK IHT on UK assets. Now, Gunella acquired the farmland on 1st November 2020. It has been let to tenant farmers since that date. The agricultural value of the land on 1st March 24 was 180,000. See, when you let out agricultural property, then for agriculture property relief, the minimum ownership period required is 7 years. Here, 7 years aren't done. If you don't remember the rules of agriculture property relief, again, you can go here, write agriculture property relief. If the property is let out, then the minimum ownership period is 7 years. If you are dealing with agriculture on your own, then it's 2 years. Now here he acquired the property on 1st November 20 and he is let out. Now on 1st March 24, obviously 7 years aren't done. Guenella's only lifetime gift was to her niece Lisa on 1st June 20. This gift consisted of a house situated in UK with a market value of 210,000. Obviously, it would be using the nil rate band. Okay, we have to deal with the IHT for legacy received by Ulf. Legacy means what you are getting through death state. So the nil rate band of Gunala will be used due to her lifetime gift. Believe me, it's very easy. When we'll be actually drafting the answer, you will understand it in a very easy manner. Believe me, it's very easy. Now, extract from an email from your manager dated 1st June 24. Please carry out the following work. Part A, professional conduct of Lucia's previous tax advisor, Exhibit 1. Send me an email explaining the fundamental principles set out in ACCA's Professional Code of Ethics and Conduct, which Lucia's previous tax advisors appear to have breached. Now, if you remember the Professional Code of Ethics, there are 5 principles: integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Now, we have already discussed this entire note of ethics in detail during our course discussion. Let me open that handout for you guys so that you can remember it. Okay, so if you remember this ethics handout, which we have already studied during our course discussion, in which I have given all of these details, in which I first discussed some routine ethical situations which examiner normally asks. If you remember, we discussed all of this. It's a very good document, and you will always get a 5 marks requirement from it. And then we discussed important concepts to remember, in which we discussed this fundamental principles of code of ethics. There are 5 fundamental principles: integrity, we have to be straightforward and honest; objectivity, we have to be neutral in our work, we shouldn't be biased; professional competence and due care, whatever we are doing, we should have the professional competence and the skill to do that work. And due care means that we should do our work in a diligent manner. Confidentiality, we should maintain the confidentiality of the client's document, we shouldn't be compromising that. And professional behavior, we should avoid any action which can discredit our profession. These 5 ethical principles. Now, if you go and refer it, what he's asking, send me an email explaining the fundamental principles set out in the ACCA's Professional Code of Ethics and Conduct, which Lucia's previous tax advisor appeared to have breached, for 5 marks. So now, if you go and look at the Lucia's previous tax advisor, the way the previous tax advisor was critical of the competence of other local accountancy firm. So first of all, this is an issue of professional behavior. As a profession, we shouldn't be criticizing others because they also represent the profession. It discredits the overall accountancy profession, number one. Number two, they lost our documents and they made a false claim, which is making a false claim is an issue of integrity. And then obviously it's an issue of due care, that they weren't doing their work with due care. How they lost our documents, they didn't submit it. And obviously losing the documents is also an issue of confidentiality, because maybe it goes in some bad hands or someone may be misusing them. Okay. So you have to explain the relevant code of ethics points and then you have to relate it to the scenario. So apparently it was an issue of integrity when they falsified. It was an issue of due care when they failed to submit the documents. It was an issue of confidentiality because they lost them. They compromised the confidentiality of the client. Maybe it goes in God knows whose hand it will go. And number fourth, it's an issue of professional behavior because they are discrediting other accountants, which is obviously not a suitable behavior if we are a professional accountant, because ultimately we are discrediting the profession. So you can refer the 4 points of the code, you have to explain them, and obviously you have to relate it to the scenario. And then we have to prepare a memorandum in part B. Since it's question number 1, so there are 40 technical marks in which we have to respond to the instructions of the email. And then there are 10 professional skill marks for communication, which means proper headings, format, wherever the email you have to make, wherever you have to make a memorandum, the formats, your headings, your communication, clear communication, Analysis of the taxation rules. Evaluation means relating to the scenario. Skepticism means to question the data wherever the data is incomplete or wherever you feel that anything is mistaken, you have to question it. And commercial acumen to hold a practical approach. When we will be answering the question, we will be demonstrating these professional skills also. Okay, so let's start with it. We are dealing with the part A. We will be drafting the answer as we progress further. I want you all to listen to me carefully. Okay, so the question name is Lucia. I want you all to listen to me carefully. This is the first requirement which we are dealing. Part A, professional conduct of Lucia's previous tax advisor. Okay, and in this part A, we have to prepare an email. Please read it carefully. Send me an email explaining the fundamental principles. Now you are obviously replying to the manager, so you will be a tax senior. Okay, to tax manager from tax senior. Okay, from tax senior. What's the date? You can refer the date given in the question. It's 1st June 24. Date 1st June 2024. Subject ethical issues in relation to previous tax advisor of Lucia. Okay, see, this is the basic format which you have to follow. Either you make an email or you make a format of a memorandum. This is a basic format which you have to follow. Okay, so now what he has asked us, send me an email explaining the fundamental principles set out in ACCA's Professional Code of Ethics and Conduct, which Lucia's previous tax advisor appeared to have breached. So ACCA's Professional Code of Ethics and Conduct, okay, principles breached by Lucia's previous tax advisor, principles of ACCA's Code of Conduct, Code of Ethics and Conduct, breached by Lucia's previous tax advisor. This is what we are answering. Now you will explain, first of all, that what principles have been breached. You will explain them and then you will relate it. ACCA's Professional Code of Ethics and Conduct. If you use these specific wording, it will be beneficial. Otherwise, also it's not an issue. ACCA's Professional Code of Ethics and Conduct breached by Lucia's previous tax advisor. Now, Lucia's previous tax advisor has breached following principles of ACCA's Professional Code of Ethics and Conduct. Number one, integrity. Integrity means that a professional accountant must be straightforward and honest in his dealings. Lucia's previous tax advisor falsified to Lucia that they have submitted documents to HMRC when in reality they failed to submit it. This shows that they have breached requirements of integrity. Okay, so now if you look at it while I'm drafting it, you have to be very simple. In normal language, you can explain it. There is no specific language which you have to use. You just explain and then you relate it that how they have breached. Then, secondly, due care. Due care means that a professional must perform his duties with care and in a diligent manner. Okay? Lucia's previous tax advisors did not exercise due care as they failed to submit documents to HMRC when required by them. Okay. Third, confidentiality. This means that a professional must ensure that confidential data of client is not breached in any form. It do not gets disclosed. It is not breached. Okay, it's not breached in any form or it's not disclosed in any form. Now, previous tax advisors of Lucia lost the documents in relation to Lucia's engagement, which creates a concern of confidentiality as they may get accessed by some unwanted person or some irrelevant person to whom they shouldn't have been gone. So it's a breach of confidentiality. So you have already studied these principles of the Code of Ethics. You are just referring them, explaining them, and you are relating it to the scenario. And lastly, professional behavior. This means that a professional should avoid any behavior which discredits the profession as a whole. Previous tax advisors of Lucia used to criticize other local accountancy firms. This discredits the overall discredits the accountancy profession as a whole, as other local accountancy firms are also serving the same profession. Because when you say that, see, the other peoples are not good, they are not doing the right work, and we are doing the correct thing. Question is that who gave them the license? Who licensed them to do that work? Obviously, the professional body gave them the license. It's the same professional body which gave you the license also. So if you criticize other service providers, effectively you are criticizing the body. And when you criticize the body, it's the same body which gave license to you also. So in reality, you are creating question mark on the profession as a whole. It do not suit to a profession. It's not a professional behavior. Okay. So part A, professional conduct of Lucia's previous tax advisor. We just pasted the requirement. 5 marks. He asked us to make an email. Send me an email. So we wrote to, from, date, and subject. It's better in question number 1 that you use headings. It's better. It will help you in gaining the communication skill marks. Principle of ACCA's Professional Code of Ethics and Conduct breached by Lucia's previous tax advisor. And then you started drafting it. Lucia's previous tax advisor has breached following principles of ACCA Professional Code of Ethics and Conduct. Integrity, because they made a false statement. Due care, because they failed to submit the documents. Confidentiality, because they lost the documents. Maybe some unwanted person get them. Irrelevant person gets it. And professional behavior, because they were discrediting the other service providers. So, a very simple 5 marks requirement. At advanced taxation level, you will get a 5 marks requirements always in question number one. It's mandatory. Okay. And for that, this document of mine is a life-saving document where I've summarized all the routine requirements and some additional concepts also. Now let's move to part B. Prepare a memorandum for Lucia's client file consisting of the work set out below. Lucia's personal tax affairs. So part B is in relation to Lucia's personal tax affairs, which we have to deal with. Okay. And then part C is in relation to inheritance from Gunella. So let's look at it. Part B, memorandum for, if you can refer it, memorandum for Lucia's client files. Part B. Now we are dealing with it, part B. Now here again he has asked us to make a memorandum. Now again, the same format which you will be using. You are making a memorandum for client file to the files, because as it states, memorandum for the client files. In the client documents, it will be included. From tax senior or supervisor, client Lucia, subject Lucia, personal tax affairs. Subject is Lucia's personal tax affairs. Okay. Date, it was given in the question. It's 1st June 24. So it's just a routine format which you have to make. And I believe it's not difficult. It's just following the instructions of the examiner. Just do whatever the examiner is saying. He said, okay, make a format of memorandum. You gave the heading, memorandum. It's the same format always. There is no introduction or conclusion, nothing like that. To, from, client name, subject, date, a routine format. Just follow the instructions of the examiner and you are getting these easy marks. Part 1. Chargeable gain on the sale of waterside cottage. Part 1 for 3 marks. Let's deal with it. Okay. Chargeable gain on the sale of waterside cottage. Explain with supporting calculation how the chargeable gain on Lucia's sale of waterside cottage will be calculated. How many marks? Simple 3 marks requirement. Let's look at it. Here it was. The only chargeable asset I have previously disposed is a house, a waterside cottage, which I sold on 1st January 24 for £229,000. My mother Mika gave the house to me on 1st November 23 when its market value was 225. We submitted a joint claim for gift holdover relief in respect of this gift. My mother had always rented out the house as qualifying furnished holiday accommodation, but I decided to sell it in order to finance the expansion of my business. I did not live in the house. My mother inherited Waterside Cottage from her uncle, who purchased it for 130,000 on 1st November 17. On 1st May 15, when my mother inherited the house, it had a probate value of 216,000. So we need to calculate the chargeable gain on sale of this waterside cottage. Now you can do these calculations on spreadsheet also, but for explanation you will have to use the word processor document. I particularly feel that solving it on a single screen is much easier. So instead of using spreadsheet, I use this table function available on the word processor. But if someone wants to do these calculations in spreadsheet, that is also completely possible. Now, what's the disposal proceed? We are disposing it on 1st January 2024 for 229,000. Now, cost. So for cost, we need to be careful because gift holdover relief was claimed in relation to it. Okay, for cost, we need to be careful. Now, cost of cottage will include working of base cost as gift holdover relief was claimed in relation to gift of asset by uh, Lucia's mother, Mika, when she gifted it to Lucia. So at that time, the gift holdover relief was claimed. So when you claim gift holdover relief, obviously you need to do the working of the base cost. Okay, now listen to me carefully. Market value at the time of gift. Now, this is a very basic practice question type thing which we are doing. The market value at the time of gift was 225,000. Listen to me carefully. I'll repeat the things also. Now, what will be the gift holdover relief claimed on gift? That gift holdover relief will reduce the base cost, and then that base cost will be deducted from here. Okay, so now let's look at it. Gain arising on gift transaction was, if you look at it carefully, what was the gain arising on gift transaction? Market value at time of gift was 225,000. Cost for Mika. What was the cost for Mika? For her mother. For her mother, the cost was 216,000 because she got the house as inheritance. So the probate value will be the cost. I will repeat the things again, okay? 216,000. Mika got the house as an inheritance from her uncle. So it will be transferred at probate value, the value at time of death. So the gain was 9,000. This gain was deferred through gift holdover relief. This will reduce the base cost for Lucia. The base cost will be 216,000. This will come here, and then you will get your chargeable gain of 13,000 pounds. Now, I know that you guys will have a lot of questions in your mind which need to be cleared. So, for that, I will request patience. Okay, because I will repeat the things, and I think patience will be required in relation to it. First, let me adjust the column sizes. Okay. The chargeable gain is 13,000. This base cost was 216. This was the gain. Let me repeat it again. A simple 3 marks requirement, chargeable gain on the sale of waterside cottage. See, you are selling this waterside cottage for how much? 229,000. What was the cost of this cottage? Let's think about it. You got this cottage as a gift from mother, and its value at that time was 225. So whenever you get anything as a gift, the market value becomes your cost. But it is written that at that time, gift holdover relief was claimed. Gift holdover relief reduces the base cost. Okay. So you said, okay. Cost of cottage will include working of base cost as gift holdover relief was claimed in relation to gift of asset by Lucia's mother Mika when she gifted it to Lucia. So the market value was 225. Now, what was the gift holdover relief which was claimed at that time? So, for gift holdover relief, you need to think about the element of gain which must have arisen at that time. Gain arising on the gift transaction was market value at the time of gift was 225. Cost for Mika, her mother got this house through inheritance. So for her, the cost was 216. 225 minus 216. The gain was 9,000. This 9,000 worth of gain was deferred through gift holdover relief, which he stated here. We submitted a joint claim for gift holdover relief. So this 225 reduced by gift holdover relief, the base cost was 216. Here you put it. So the chargeable gain on the disposal was 13,000. Now, see, it was just a 3 marks requirement. It was a very easy requirement. Believe me, a student of skills module taxation can also do it. But sometimes the students are not very much clear in the concepts and they are not very much attentive in the examination. And as a result, what happened is that they are even not able to solve these easy requirements. They cannot connect the data that, okay, this has happened. And they lose these easy requirements. Your concept in the mind should be very clear. Okay, we are selling it for 229, we need a cost. Okay, so now what's the cost? We are selling it for 229, it's clear. What's the cost? We got it as a gift, so 225 is the cost. But we submitted a gift relief at that time. So now for gift relief, we need to go back one step. Now his mother got it as inheritance. The probate value was 216 when her mother got. So the difference was the gain, which was deferred through gift holdover. And that gift holdover will reduce the base cost. That base cost becomes your cost. And here you go with your chargeable gain. I believe that you are understanding it. Okay, now part 2. Now comes the bigger part. Lucia's post-tax income for the tax year 25-26. A 7 marks requirement. Okay, let's look at it. It's a bigger requirement. So obviously, there will be a lot of data. Let's read it that what he's saying. Okay. Okay. So calculate Lucia's expected post-tax income for the tax year 25-26 by reference to the information in Exhibit 2 and additional information below. 1. Use a figure of 79,000. Just a second. Use a figure of 79,000 pounds for both the accounting profit and taxable trading profit of LRA Limited for the year ending 31st March 26. The only adjustment to be made to this figure are in respect of any amounts paid to Lucia. LRA Limited will have no other incomes or chargeable gains. In the tax year 25-26, Lucia will be paid a gross salary of 70,000 pounds, together with a dividend equal to LRA Limited's expected post-tax profits. Now we are assuming that the profits will be 79,000. From this, a salary of 70,000 pounds will be paid. Obviously, when you pay a salary, you also have to pay Class 1 employer NIC. When you pay a salary, you also pay Class 1 employer NIC. So after that, you will get the profits on which the company will pay the corporation taxes, and then you will get the post-tax profit. In the year ending 31st March 26, Class 1 national insurance contributions payable by LRA Limited in respect of Lucia's existing employees will exceed the employment allowance. That employment allowance, a certain amount of the Class 1 employer NIC which gets waived off. So that will be already used. So you have to ignore that. You should ignore any reliefs which may be available in respect of the Lucia's budgeted trading loss for the year ending 31st March 25 when calculating Lucia's post-tax income. 7 marks. So now, what we have to do is that we need the Lucia's expected post-tax income. So Lucia will be getting 70,000 as a salary. she will be getting some dividend. On this salary and dividend, obviously, she will have to pay income tax and class 1 employee NICs. I want you all to listen to me carefully. It's a pure requirement of calculation. So, very minimum explanations will be done. Only the calculation will be focused major. So let's do it. It's an interesting requirement. When you will listen to me carefully, you will be able to understand in a better manner. Okay. So now what will be the Lucia's post-tax income for the tax year 25-26? Lucia's salary from LRA Limited. So as stated, she will be getting a salary of 70,000 pounds. Okay. Listen to me carefully and you will be able to understand in a better manner. Lucia's dividends from LRA Limited. Now, this we don't know because the question stated that it will be equal to the post-tax profits. It will be equal to the post-tax profits which LRA Limited will have. So for that, we need to calculate the post-tax profits of LRA Limited. Okay. And then income tax payable by Lucia. Lucia will have to pay some income tax because we have to calculate the post-tax income. And class 1 employee NIC payable by Lucia on her salary. Obviously, she will have to pay class 1 employee NIC also. So then we will be able to get her post-tax income. We will get Lucia's post-tax income for tax year 2025-26. And that will be our answer. Let me repeat it again. Lucia has a salary of 70,000 pounds. That's given in the scenario. You can refer it. She will be getting some dividend equal to LRA Limited's expected post-tax profit that we need to work out. Then she will have to pay income tax. She will have to pay class 1 employee NIC, and then we'll get the post-tax income. Okay, so let's deal with it. Working 1. Okay, working 1, dividend to be paid by LRA Limited. Okay, what will be the dividend? Now, profits of LRA Limited. The profit value given to you in the question is 79,000. See, now this question is basically an open question, like no specific format. You have to deal with the data carefully. Profits of LRA Limited are given to you of 79,000. Salary expense paid to Lucia, 70,000. See, the question stated that this profit is 79,000. The only adjustment to be made to this figure are in respects of the amount paid to Lucia. Okay, now, class 1 employer NIC on salary of Lucia. Obviously, that will also be paid. Now, for class 1 employer NIC, 70,000 minus 9,100. If you remember, the class 1 employer NIC 0% band. And then the class 1 employer NIC rate is 13.8%. I hope you all remember the rates. If you don't remember the rates, those will be given in the examination in the tax rate sheet. So 70,000 minus 9,100 into 13.8%. So that's 8404. If you guys don't remember that how you have to access the text tables on the left bottom, here the extract will be help/text tables, and you can go in the text tables where you can find the tax rate sheets. Okay, you can scroll down and you will find the rates of NIC. Okay, till 9,100 it's 0% and then it's 13.8%. I hope you all know that how you have to reach this tax rate sheet. So, profit of LRA Limited, what's the profit of LRA Limited? 79,000 minus 70,000 minus 8404. So it's 596 pounds. Corporation tax on profits of LRA Limited. Obviously, the company will have to pay corporation tax on it. 19% is the corporation tax rate, which is the small rate. 113 pounds. So, post-tax profit, which can be used to pay dividend. So 596 minus 113. So it's 483 pounds. So this 483 pounds will be the dividend that will be paid to Lucia. See, it's an interesting question, but obviously, as I say that, it's not something which is going in a predefined format. It's something that which you have to explore. Every step you are exploring that, okay, this is the way out, this is the way out, you're exploring it. You have to look at the data carefully, obviously. 70,000 was the salary. Then they will pay dividend equal to the post-tax profits. Okay, so we said what will be the post-tax profit? 79,000 was the profit. 70,000 was the salary, class 1 employer and IC. You got the profits of LRA Limited. You applied corporation tax on it and you got the post-tax profit. Now comes the income tax payable by Lucia. So let's do working 2. Income tax payable by Lucia. So Lucia is getting a salary of 70,000 pounds and a dividend of 483 pounds. So the total income will be 70,000 minus 483, oh sorry, 70,000 plus 483, obviously 70483. You will deduct your personal allowance 12570. So you get your taxable income. So that's 57913. Then you charge tax on it. Now your non-saving income will be, in non-saving income there was a salary of 70,000 from which you deducted the personal allowance. I hope you all know that we deduct the personal allowance from non-saving income. If you want, you can make the columns from the start also. But I believe this is something very much basic at advanced taxation level. So you can split it while doing the calculation also, that's permitted. So 70,000 minus 12570. So your taxable non-saving income was 57430 on 37,700 pounds. It's 20%. That gives you 7540. And then 57430 minus 37,700. You will apply 40% on the remaining. I will repeat the things again also, so if you have any query, it will get cleared. But obviously, the patience will be important. So it's 7892. Okay. And in relation to dividend, dividend was 483 pounds. It will be covered in 0% band, because I hope you all know that on dividends you get a 0% tax band. Okay, if you remember these, again you can refer the tax rate sheet, because it is something which will be provided in the examination, the dividend nil rate band. So obviously 483 pounds will be covered in the 0% band. And here you go, it is your total income tax. 7540 plus 7892, so that gives you 15. 15432. Okay. Sir, will you repeat it? Yes, I will repeat it. There is a lot of basic calculations going on. 15432. The salary value was available in the question. Dividend we have to calculate because he stated that the dividend will be equal to the post-tax profits which LRA Limited will have. So what will be the post-tax profit? 79 less the salary, the employer NIC, profit, corporation tax, and this was the post-tax profit which came here. Income tax 70,000 plus the dividend. Total income, you deduct the allowance, you get the taxable income. Now, when calculating the tax, obviously you need to split up the non-saving and the dividend. You obviously adjust the personal allowance against the non-saving. Here we didn't show them separately, but obviously while applying the tax rate, you have to show it separately. 70,000 minus 12570, 37,700 goes at 20% and remaining at 40%. And obviously the dividend will be covered in the 0% band. The last thing is class 1 employee NIC payable by Lucia on her salary. Working 3, class 1 employee NIC payable by Lucia on her salary. So what will be that? Salary is 70,000 pounds. Now on class 1 employer NIC on 12570 it's 0%. That gives 0 pound. Then in between 50270 and 12570. Okay, so now we will apply the rate of class 1 employee NIC, which is 8%. On first 12570, it's 0%. And then 50270 to 12570, it's 8% rate. So that gives us 3016. Okay, and then on the excess, the rate of class 1 employee NIC, it's 2%. I hope you all remember the rates. These rates are also available in the tax rate sheets in your examination. Okay, then on the remaining salary, it's 2% rate. So 70,000 minus 50270, we apply 2% rate on it. So that gives us 395. Okay, so this gives us our total class 1 employee NIC. So that will be 3016 plus 395. So that will be 3411. Okay. I will repeat the things again also. So your patience will be very important while we discuss these things. So this is your class 1 employee NIC, which you will deduct from here 3411. So Lucia's post-tax income for the year will be 70,000 pounds plus 483 minus 15432 minus 3411. So that gives us 51640. Okay, let me repeat it again. See, the question was about Lucia's post-tax income for the tax year 2025-26. So we first of all wrote the Lucia's salary from LRA Limited, that was 70,000 pounds. Lucia's dividends from LRA Limited, for which we did working number 1. We wrote the profits, we wrote the salary expense, we deducted the class 1 employer NIC. The profit remaining of LRA Limited, on which LRA will pay corporation tax. See, obviously the dividend is paid from the post-tax profits. So the company will get its post-tax profit. This was used to pay the dividends. We reflected it here. Then income tax payable by Lucia, salary 70,000, dividend 483. You got total income, personal allowance, you got the taxable income. Now, non-saving income on 12570 was your personal allowance. On 57430, first 37,700 was subject to 20% rate. On the remaining, you charge 40% rate.
Dividend 0% tax band is of £500, you all know. So that leads to £0 of dividend income tax. So your total income tax was 15432. Then you calculated the class 1 employee NIC. You all know these rates. These rates are also available in the tax rate sheets in the tax tables. Okay. 50270 minus 12570, 8% rate, and then the rate is 2%. You applied these rates and you got the Lucia's post-tax income for the tax year 25-26. Okay. So if you look at your questions, okay, you have already read these scenarios, we have already covered it. We did the requirement in relation to the ethics, and then we are looking at these, all of the requirements which we are discussing. Okay. So in the Lucia's tax affairs, we have discussed that how her income from LRA Limited will be impacted. Okay. Now we are moving forward. Okay. Now we are moving forward. We will be looking at the next requirement, which is in relation to loss relief planning. Okay. We did the requirement in relation to ethics. Okay. I hope you all remember. Then we did this requirement in relation to chargeable gain on sale of waterside cottage. Okay. If you remember, we did it. Okay. We calculated the entire chargeable gain. And then we did this Lucia's post-tax income, which involved a lot of basic level workings. The figure of the profit was provided. A salary of 70,000 is to be paid. We calculated the profits of the company. We calculated corporate tax on it. We used the amount of dividend which will be used to pay the dividend amount that became part of the Lucia's income. We calculated the Lucia's income tax, and we calculated her class 1 employee NIC. I believe that there was nothing difficult in it. Now we are moving towards the next requirement, which is a very interesting requirement, and I would say one of the difficult requirement, a bit difficult requirement of this question. Relief available in respect of the Lucia's budgeted trading loss. This is a very important requirement. Okay. Now, this is one of the requirements in which the students may have some problems in their mind, but as we will solve it, believe me, it will get crystal clear in your mind. Okay. So now we will be doing this part 3, which is in respect of budgeted trading loss, which Lucia budgets to get. So now we'll read this requirement, which is an 11 marks requirement. We will read the relevant parts of the scenario again, and then we'll start solving it. Okay, I hope that till now the question has been easy. The requirement of ethics was very easy. Number 2 requirement was just to calculate the chargeable gain. That was an easy one. Third requirement was in relation to post-tax income, which involved a lot of simple steps to be done. Okay, like I believe that these steps which we perform, like the calculation of income tax, class 1 employee NIC, class 1 employer NIC, these are not the difficult things, at least at advanced taxation level. Then in the part 2, the workings in relation to the gift relief and all, that all was basic thing. Ethics requirement was very easy because that is something for which we already had a detailed lecture during our classes for the ethics. So now let's move towards part 3, which is in relation to reliefs available in respect of the Lucia's budgeted trading loss. I want you all to listen to me very carefully while we discuss it. Okay, so now first of all, we will read the entire requirement in detail, then we'll read the relevant exhibit, and then we'll be drafting the answer. Explain the reliefs available both now and in future in respect of the Lucia's budgeted trading loss for the tax year 24-25 and compare the possible tax savings available. You should note the following additional information. Opening year loss relief is not available in respect of this loss. You are not required to consider terminal loss relief, as I've already carried out the necessary work in respect of this relief. You should ignore the national insurance contributions. The requirement is of 11 marks. So we have to talk about the loss reliefs available, which we can claim. If we claim the loss relief now, which means either in current year or in previous years, which means relief to be claimed now, or if it is to be claimed in future. Future means the carry forward loss options. We are not required to consider the opening year loss reliefs, nor we are required to consider terminal loss reliefs. So this means that we have to solve this question through normal loss relief options. Okay? It is about the individual trading losses. Now, in individual trading losses, if we talk about the reliefs, the options are you can offset your current year total income, you can offset your previous 12 months total income. Once you have offset the total income, you can go towards offsetting against the chargeable gains. Okay, the question has stated very clearly that you are not required to consider about the opening year loss reliefs or about the terminal loss reliefs. See, normally in the loss relief questions, the students get a bit confused. But I always say that just read with patience and believe me, it will get crystal clear. Now we'll be going and referring the relevant exhibit again. We have already read this entire text affairs of Lucia. I hope you all remember. But we'll be referring the relevant information again so that you can have a better understanding. Okay. Now the entire information in relation to this is in exhibit number 2 because exhibit 1 was just a basic introduction about the scenario. Exhibit 3 is in relation to legacy received by Ulf, which is obviously not relevant to this. The entire discussion is in this exhibit 2, which is Lucia's tax affairs. So we'll quickly walk through this exhibit and then we'll start discussing the answer. I want you all to listen to me very carefully. It's easy, but your patience and concentration will be very important. Now, extract from a letter from Lucia dated 1st June 24. Following our recent discussion, I decided to incorporate my business. I will transfer all of my business assets to LRA Limited on 1st April 25. In exchange, I will receive ordinary shares in LRA Limited as a consideration and will own whole of the company's share capital. You confirm that incorporation relief will be available such that the transaction will not give rise to immediate capital gain tax. We have already read entire of this data. We have already attempted two requirements. So he was doing his unincorporated business and now he's converting it into a company structure. Then there was discussion in relation to disposal of waterside cottage, which we have already dealt, if you remember, in the requirement number 1, in relation to the chargeable gain on sale of waterside cottage, where we said that the chargeable gain of £13,000 will be arising. Okay, we have already discussed this disposal of waterside cottage. Okay, I hope you all remember. So I'm not reading it again because we have already discussed it. Now, the important thing is here, which is results of my unincorporated business. In the tax year 22-23, Lucia had a profit. In 23-24, she had a profit. In 24-25, she is having a trading loss. And this question is also about this trading loss which she is suffering in the year 24-25. So basically, we are talking about this trading loss of £40,000, which she has suffered in the tax year 24-25. My business is my only source of income. This means that in 24-25, she had no income, she had a loss. In 23-24, she had income of 30,000. Okay. Other than that, there was disposal of this cottage, which was on 1st January 2024. 1st January 24 is also tax year of 23-24 because 1st January 24 means tax year will be ending on 31st March 24. So it's 23-24 on which there is a chargeable gain of £13,000. Okay. Now, LRA Limited plans for the year ending 31st March 26. Talking about the next tax year, which is 25-26. And now it's about purchase of business premises and all of those details. Okay, obviously it's clearly indicating that here we are talking about the value added tax things. So apparently it's clear that these VAT parts will have no relation to this loss relief planning. So we have to talk about this trading loss, which is of 2024-25, and that is of £40,000. Now, before drafting the answer, I want you all to sit with patience, just relax, take a deep breath, and just listen to me very carefully. What did the question ask? The question said, explain the reliefs available both now. Now means the relief which you can claim immediately and in the future. Both now and in the future. Now, when I say this word relief available now, it means a relief either in current year or a relief in previous year. Current year or carry back. That is now. Because when you offset in current year or you offset the previous year return, you get immediate relief. Now, immediate. Current year or carry back is immediate relief. Future is carry forward. So both now and in future. Now means current year or carry back. Future means carry forward. Okay, if you don't know, keep it in mind. Now means current year or carry back, because when you go for carry back, you get relief immediately because you're revising the previous year return. Future means carry forward relief option. Okay, now the question is clearly stated. Don't think about opening year losses. Don't think about terminal loss relief options. Okay, if you simply go to your summary notes, you write individual losses. Okay, individual loss reliefs. If an individual suffers a trading loss in a normal trading year, set up against current year total income, set up against last 12 months total income. Future is not the option here because first we are talking about now. So current year and carry back. Okay. You can also offset your capital gains once you have offset your total income. So now current year total income or previous 12 months total income. Once done with that, you can go for the capital gains. Okay. Now if you look at the scenario, if you look at the scenario, after 24-25, there is no data given, which means in the next year, there is no unincorporated business. Because if you look at it, we were transferring our business to LRA Limited. Unincorporated business will end in 24-25, and then there will be structure of company. So for that, if you remember, we have studied this. If an individual operates an unincorporated business and then converts it into a company, then losses of his unincorporated business can be offset against the profits of the company if he holds 80% or more shares. So if you go and look at the scenario, it's clearly written that he will own whole of the share capital. Just listen to me carefully. What are the relief options available now? Offset against current year total income. In 24-25, he has no income. Offset against previous year total income. That's 30,000 pounds. Offset against the capital gain. The capital gain was 13,000. That waterside cottage. These are the options available now. Options available for future. Options available for future. In future, there is no unincorporated business. We will convert it into LRA Limited. In that case, you can offset it against the incomes which you will be getting from the company. You will be getting a salary from the company and you will be getting a dividend from the company. You will be getting a salary from the company. Okay, if you go and look at this rule in the summary notes, it can be offset against the profits of the company if he owns 80% or more shares. Here, the profits do not mean that you will offset inside the corporate tax return. This means what you will be getting from the company in form of salary and dividend. Let me repeat it again. If you convert your unincorporated business into structure of a company and your share ownership is more than 80%, and if you have any unutilized losses, you can offset it against whatever you are getting from that company in form of salaries, dividend, basically whatever you are getting from the profits of the company. So here, what you are getting is 70,000 pounds of a salary and a dividend of 483 pounds. So one option is to offset against the future incomes which we'll be getting from the company. Before drafting the answer, let me repeat one more time. Options available now: offset against current year total income, offset against previous year total income, offset against the capital gains. These are the options available now. Options available in the future: since unincorporated business will be ceased, it will be ended, it will be transferred to LRA Limited, in which you will have whole of the share capital. So we can offset against the incomes which we'll be getting from the company. Okay? It will involve a lot of theoretical discussion. So what I have done is that I've already drafted this answer for you guys, and now we will discuss it. Okay? Since it's theoretical discussion, so it will take a lot of time in writing it, in typing it. So I've already drafted this particular part. Okay? When you will read it, you will understand it in a better manner, because if I will spend a lot of time in typing, you won't be able to understand it. So reliefs available in respect of Lucia's budgeted trading loss. Okay? I have typed it for you guys. So we will just refer that and I will discuss it along with you. Just listen to me carefully how I discuss it. What are the relief options available? Loss relief options available to Lucia if she wants to relieve the loss now. If she wants to relieve the loss now. Offset against current year total income. Offset against previous year total income. Offset against the capital gains. Listen to me carefully. Loss relief options available now: offset against current year total income, offset against previous year carry back total income, offset the capital gains. The loss relief option available for the future: normally in individuals, trading loss will offset future trading income. But since here the business will be ended, there is no unincorporated business now. The business will be closed. It will be converted to structure of company. So if Lucia wants to relieve the loss in future, then she can relieve its trading loss of unincorporated business against the incomes she will get from LRA Limited. This is possible because Lucia has transferred her unincorporated trade to LRA Limited and her shareholding is more than 80%. It can be offset against the salary or dividends which Lucia will get from LRA Limited. See, the first question was that what are the reliefs available? What are the reliefs available? So the reliefs available are now. What are the reliefs available? Now, current year total income, previous 12 months total income, or offset the capital gains. These are the options available now. What is the option available for the future? In a normal individual trading loss, the option is to offset future trading income. But here, there is no future trading income because the business is transferred to LRA Limited. There is no income of unincorporated business now. So, this point of the summary notes will be applicable. See, these summary notes are life saving. These are most critical in your finalization phase of preparation. So, the options available now and option available in future. Now, compare the possible tax savings available. Now, let's look at the savings. Let's look at the savings. I want you all to listen to me carefully. If Lucia will offset against current year total income, then no loss relief is available. Why? Because in current year she do not have any income. In current year, in 24-25, she has a loss. This is her only source of income. She has a loss. In current year, she has no income. In current year, she has no income. She has a loss. In current year, she has no income. Okay, so let's go back. Previous year, loss relief claim in previous year against total income of 30,000. This is her previous year income against income of 30,000. So 12570 is your personal allowance. Obviously, saving is after adjusting the allowance. So 17430 into 20%. So the saving will be 3486. The loss is 40,000. The loss is 40,000. Previous year income 30,000. The saving will be 30,000 minus 12570. Okay. So that gives you 20%, 3486. Remaining loss of 10,000 can be relieved against the capital gain of waterside cottage, on which the gain was 13,000. 13,000 was the gain, 3,000 was the annual exemption. 13,000 was the gain, 3,000 was the annual exemption. 10,000 pounds. The tax rate on waterside cottage is 18%. The reason being is that waterside cottage was a residential property. The waterside cottage was a residential property. It was a house. Okay. So if we offset in current year, there was no relief because in current year she did not have any income. In current year in 24-25 there was only loss. If we go for previous year, 30,000 was the total income. After adjusting personal allowance, the saving was 3486. 40,000 was your loss. 30,000 offset against the total income. 10,000 is remaining. You offset your capital gain. So in this option, total saving is 5286. You offset your current year total income. Option 1. Option 2, you offset previous year total income and capital gains. What are other options? Instead of offsetting the capital gain, instead of offsetting the capital gain, if I carry forward this remaining loss, another option can be that rather than offsetting the chargeable gain, Lucia can carry forward remaining loss of 10,000 pounds against future incomes of LRA Limited, which includes a salary of 70,000 and a dividend of 483 pounds. Remember, you yourself calculated in the previous part salary of 70,000 and dividend of 483. So instead of offsetting the capital gain, if we move it against the future incomes, because the option to offset the capital gain is not mandatory. Okay. Option to offset the capital gain is not mandatory, it's our choice. Whenever relief is claimed against total income, capital gain of that year can also be set off. It's not mandatory. In order to go for capital gain, you have to offset the total income. Once you have offset the total income, it's not necessary to go for capital gain. If you want, you can go for it. Otherwise, you can go for future incomes also. In future, it has a salary from LRA Limited of 70,000 pounds. If she will offset 10,000 against that, so obviously 70,000 is in higher rate band. So the 10,000 which you will offset will generate saving at 40%. So in this case, your saving will be 3486, which you offset in the previous year total income, and 4,000, which you offset in the future. Option 1, current year total income. Option 1, current year total income. There was no income. Option 2, previous year total income and previous year gain. Option 3, previous year total income. And rather than offsetting the gain, we directly move to the future incomes. And one last option is to carry forward the entire loss. Last option can be Lucia carry forwards entire loss of 40,000 pounds against her future incomes from LRA Limited. In this case, existing salary of 70,000 pounds will be, what will be your saving? 70,000 minus 12570 minus 37,700. Now you must get confused here. You must get, I use the word. That's normal. See, I'm offsetting my loss of 40,000. My salary is 70,000 pounds. When I will offset 40,000 against it, some relief will be in higher rate band and some will be in basic rate band. 70,000 minus the personal allowance minus the basic rate band. So 19730 was taxed at 40%. You can verify this from here also. You can verify this from here also. If you remember your higher rate band space, which you taxed at higher rate band, okay, 57430 minus 37,700. It was 19730. You can do it on your calculator also. So you will offset this higher rate band portion into 40%. This you are saving this tax 7892, and the remaining loss will be relieved at the basic rate band 20270 will be relieved at 20%, which will give you a saving of 405. Total saving in this option will be 11946. I know that you may be getting confused. It's normal. This is the reason why I'm not typing the answer. I'm just explaining it to you. Because I'll type along with it, you won't be able to understand. Let me repeat it again. You must have queries in your mind. I use the word must. That's normal. Everyone have that query. Let's look at it. What were the relief options? If you relieve it now you want immediate relief, offset against current year total income, last 12 months total income, offset against the gains. Current year total income, last 12 months total income, and then offset against the gains. Future, normally trading loss offsets future trading income. But here, there is no future trading income. Here, there is no future trading income because we have transferred the business to LRA Limited. But we have shareholding in LRA Limited of more than 80%, so we can offset against the incomes which we will be getting from them. These are the options. These are the options. Now, comparison of possible tax saving. If Lucia will offset against the trading loss of current year, no saving because in current year you don't have any income. You only have a loss. You only have a loss. In current year, you don't have any income. If you go for previous year, you offset 30,000, but your saving will be after personal allowance, 17430 into 20%. Remaining loss, you can offset against your capital gain of 13,000. This waterside cottage, if you remember, you offset against your capital gain. It's a house. So this is your saving. If you don't want to offset against the chargeable gain because that's not mandatory, you can carry forward the loss against the future income. Your future income is a salary from LRA Limited. 70,000 pounds, it's in higher rate band. You are just offsetting 10,000. So when 10,000 will offset 70,000, it will be at the higher rate band in the last portion. Last option is that you say, no, I don't want to do current year. I don't want to do carry back. Only carry forward. Only carry forward. You carry forward 40,000 to future. You have a salary of 70,000 and a dividend. Obviously, salary, non-saving income has higher tax rate, so you will relieve there. 70,000 minus the personal allowance minus the basic rate band. You get the amount which is being taxed at higher rate. So 19730 relieved at higher rate band. Your loss was 40,000. 19730 relieved at higher rate band. Remaining amount relieved at basic rate band. So your total saving in this option will be 78924054. Your total saving will be 11946. So if Lucia wants to claim the relief now, she will offset against the previous year income and previous year gain. No carry forward. In this option, the saving is 5286. If she want to carry it forward, her saving will be 11946. See, I know that there will be some confusions in your mind, but believe me, that's completely normal. That's completely normal. It happens with everyone. That's completely normal. Okay? If you have any query here, you need to ask. You have my direct WhatsApp number, you need to ask. Okay? So with this requirement is also done. The options available now and in future. And then what will be the savings? We looked at that. Now let's look at the next thing, which is future activities of LRA Limited. Let's look at that. Okay? Okay, so let's read in relation to value added tax. You should note the following additional information. LRA Limited will register for VAT on 1st April 2025. All of its turnover will be standard rated. For commercial reasons, LRA Limited will not opt to tax the new business premises. The capital goods scheme will apply to the new premises. Recovery of input tax in respect of the new premises. Explain when LRA Limited will be able to recover the input tax in respect of the new premises and any amount which the company will be unable to recover. So in relation to the new premises, which we have read here, he's asking in relation to it, obviously we'll go back and refer it again also, and purchase of components from overseas. Explain the VAT and cash flow implications for LRA Limited of purchasing components from a supplier based in the country of Palmyra. Total marks for this requirement are 8 marks. First, we have to talk in relation of recovery of input tax in respect of the new premises. And then we have to discuss in relation to purchase of components from overseas. Okay. So now let's go and read the relevant information and then we'll draft it. I believe it's an easy requirement. LRA Limited plans for the year ending 31st March 26. LRA Limited will purchase new business premises at a cost of £290,000 plus VAT, as its cost is more than £250,000. So when land and building has a cost of more than £250,000, its taxable use is monitored for a 10-year period. One of the room in this building, representing 15% of the building's floor area, will be rented out to an unconnected business. So on the purchase of the business, the taxable use will be 85% because 15% use is exempt use, which is renting out purpose. The arrangement will continue for no more than 4 years, as I expect LRA Limited to then need the whole of the building. Then LRA Limited will investigate the possibility of purchasing product components from a supplier based in the country of Palmyra. This would replace existing supplier situated in UK. So let's deal with it. It's an easy requirement. First of all, we need to discuss in relation to purchase of building. On purchase of new business premises, LRA Limited will have to pay VAT on its purchase of 290,000 multiplied by 20% is the VAT rate. I hope you all know this. So 290,000 into 20%, it's 58,000.
Now, if you look at the taxable use, they will be using 85% in the business and 15% of the building will be rented out. So that rented out portion represents the exempt use, so you won't be able to recover the VAT in relation to that. Okay? As taxable use of the premises in year of purchase is 85%, therefore, input tax recovery will be of 58,000 pounds multiplied by 85%. So that gives you 49,300 pounds. Okay. Premises will be used 85% in LRA Limited's business, which is a business of taxable supplies. It was written in the work to be carried out section, if you remember. If you remember, it was written here that they deal in standard rated goods. Okay. Renting out portion, renting out portion of premises of 15% will be considered as an exempt use. Okay. Now, as purchase price of premises is more than 250,000 pounds. Therefore, change in its taxable use will be monitored for 10 years. Any change in taxable use will result in VAT recovery slash repayment. Okay, it may result in additional recovery or it may result in additional payment of the VAT. Okay, now, as or you can say renting out activity of 15% of the premises will end in 4th year of the purchase. After that, 100% of the premises will be used in LRA Limited's business. Okay, it will result in additional recovery of VAT of 58,000 divided by 10 years multiplied by the 15% impact which we fail to recover. 58,000 divided by 10 years multiplied by 15%, additional recovery of 870 pounds. It will continue for remaining 6 years usage of the premises. Okay, as election of opt to tax was not done on these premises, therefore actual taxable use is being considered. Okay, so I believe it was an easy requirement as far as you remember the rules of land and building and capital goods scheme in a proper manner. On purchase of the premises, we paid VAT, but we were only able to recover 85% of the VAT. The reason being was that in the year of purchase, we were only using 85% of the building for the taxable use in our business. 15% was rented out, which was an exempt use. Okay, since the purchase price of the land and building was more than 250,000, so the taxable use was being monitored for next 10 years as per the capital goods scheme. The renting out activity will continue for 4 years. After that, he said that the whole of the building will be used in the business. So this 15% portion VAT, which wasn't recovered in the year of purchase, it will be recovered in relation to those 6 years. Every year you will be recovering 870 pounds. Every year you will be recovering 870 pounds. I believe it's not difficult. You recover VAT in relation to the taxable use in year of purchase. Then for 4 years, the taxable use remained same, so there was no adjustment. In the first 4 years, the taxable use remained same, 85%. After 4 years, the taxable use increased to 100% because you will be using entire premises in your business. So that 15% portion which wasn't recovered at the time of purchase, it will be recovered for those remaining 6 years. Okay. Now, as we move forward in relation to the purchase of the components which you are purchasing from the country of Palmyra, it will be considered as import of goods on which you will have to pay the VAT on the purchase. But since LRA Limited is VAT registered, so it will be able to recover the VAT which it is paying. Okay. Purchase of components from Palmyra by LRA Limited will be considered as import of goods done by LRA Limited. It will result in VAT payment to be made by LRA Limited on import of these items. However, as LRA Limited is registered for VAT and 100% of its business is of standard rated items, therefore, it will be able to recover VAT paid on import. From cash flow perspective, it will create same impact as it would have been if purchases would have been done locally. Because if you make purchases locally also, then also you pay VAT on purchase. And when you are registered for VAT, you can simply recover it. So I believe it was a very easy requirement. First of all, the VAT payment on the purchase, recovery of VAT according to the taxable use, reference of the capital goods scheme, reference of change in taxable use, and simply implications of VAT in relation to the import. A very easy requirement. Now comes the last requirement for 6 marks, which is a basic inheritance tax requirement, Part C, Ulf's inheritance tax from Guyana. Let's look at it. I want you all to listen to me carefully. The question is almost on completion. We have to prepare a schedule to be sent to Ulf considering of. Okay, so schedule to be sent to Ulf. Okay, so to the client files from tax senior client Ulf subject inheritance tax implications in relation to inheritance from Guyana. Date, I think it was 1st June 2024 in the question. Please don't write the date of your examination. You have to write the date which is written in the question. Okay. So now, prepare a schedule to be sent to Ulf considering of a calculation of the inheritance tax liability arising in the UK as a result of Gunela's death, and explain whether or not agricultural property relief is available. So let's go and read this stage schedule one more time and then draft its answer. Okay, so Ulf's aunt Gunala died on 1st March 2024. She left the whole of her estate to Ulf. Gunala was a widow whose husband Pietro had died on 1st December 2020. Both Gunala and Pietro had always been domiciled in the country of Boruna and had never been deemed UK domicile, which means that they are not a UK domicile holder. They will only have to pay UK IHT on UK assets only, not on worldwide assets. On his death, Pietro left the whole of his estate to Gunala. He had not made any transfers during lifetime. So unused nil rate band of husband Pietro will also be available to Gunala on the death. You should note that there is no inheritance tax in Verona and there is no double tax treaty between UK and Verona. The market value of the assets: home situated in Brunei, rental property situated in Brunei, farmland situated in UK, personal possessions in Brunei, cash at bank accounts and accounts in UK. Only these two UK assets will be subject to UK IHT because Gunala wasn't a UK domicile. Gunala acquired the farmland on 1st November 2020. It had always been let to tenant farmers since that date. The agricultural value of the land on 1st March 24 was 180,000. Agriculture property relief will not be available because it was let out, and in case of letting out, minimum ownership period required is 7 years. But here 7 years weren't completed. Gunela's only lifetime gift was to her niece Lisa on 1st June 2020. As it is within 7 years of death, so it will use the death NRV. The gift consisted of a house situated in UK with a market value of 210,000. Now, what he's asking, a calculation of the inheritance tax liability arising in UK as a result of Gunela's death. So, first of all, we need to do this inheritance tax liability arising in UK as a result of Gunela's death. Okay. And the second thing which we have to do is an explanation of whether agriculture property relief is available or not. Explanation, or you can say availability of agricultural property relief. So these are the two things which he has asked you. First of all, let's clear this. Agricultural property relief will not be available on the farmland as it was rented out by Gunela and its ownership period was less than 7 years. In case of renting out, minimum ownership period required for agriculture property relief is 7 years. That was the easy thing. Now let's do the inheritance tax liability. Inheritance tax of UK will only arise on Gunela UK assets as she was a non-UK domicile holder. Her overseas assets will not be subject to UK IHT. Okay, now her UK IHT will be, let's do the calculation. Okay, her UK IHT will only be on her UK assets. The reason being is that she was not a UK domicile holder. So it's farmland situated in UK, 470,000, and other is accounts in the UK. All other things are of Brunei: home, rental property, personal possessions. Okay, so 470,000 for the farmland and 68,000 for the accounts in UK. So 470 and 68 and 68. Total death estate subject to UK IHT, it's 470 plus 68, which gives you 538,000. Okay, there is no exempt party transfer. Now you will lead to inheritance tax on death estate. Now the first thing will be nil rate band and then the remaining IHT implication. Nil rate band will be, now what will be the nil rate band? Let's look at it. Now you can do these calculations on spreadsheet also. Okay, Gunela's own nil rate band, own debt year NRB, 325,000 pounds used against PAT which was made on 1st June 2020, as it lies in 7 years of debt, so it will use the nil rate band. It was 210,000 used against PAT made in 2020, 220,000, 220 if I'm not wrong, 210, sorry. 210,000 minus annual exemptions of 2 years, sorry, 3,000 per year. Because on lifetime gifts, you get annual exemptions also. It's a lot of basic calculations, so make sure that you don't make any silly mistake. Annual exemption of current year and last year is always available against the PAT. So available nil rate band will be 325 minus 204. It's 121,000. And that year NRB received from husband because her husband had no chargeable transfers from Pietro. He transferred his entire estate to Gunala and he had made no transfers during her life. So he had already died, so his death year NRB will be received to Gunala from Pietro, 325,000. So total death year NRB 121 plus 325, it's 446,000. See, it's always important to remember that whenever the details about the spouse are given, see, the entire question was about Gunala. Just use your mind. Why the question is telling about Pietro? It's a pure hint that you have to think about transfer of nil rate band. When I used to teach this topic in class, I always say that whenever the question tells you about the death of the spouse, it's a pure hint that he is wanting you to refer towards transfer of nil rate band. If one of the spouse dies without utilizing the death year nil rate band, then the unused nil rate band, in this case, entire nil rate band, will get transferred. Okay, so this is the nil rate band 446,000. Now, on 446,000, you will apply 0%. So that will give you £0. And the remaining 538,000 minus 446,000. So that gives you £92,000, on which the inheritance tax is obviously 40%. So it's £36,800. So total IHT arising on Junela's death is £36,800. I believe that it's not something which I would call as difficult. It was a very basic level of working which we have performed. Okay, and here you go. The question is done. A 6 marks last requirement was in relation to calculation of IHT. So farmland and accounts in UK, only the assets in UK will be subject to UK IHT. Inheritance tax on death estate, nil rate band, Gunela's own death year NRB, NRB used against PAT, which was made in 2020 because it was in 7 years of death. So it will use the nil rate band, 210,000 minus annual exemptions of 2 years, current year and last year, because there is no other gift to use the NRB. Available NRB, death year NRB received from Pietro, husband, total death year NRB, 0%, and on the remaining you apply 40%. So with this, your entire question is done. If you look at this question, I believe that it was a medium level of question, not a very easy one, but at the same time, not a very difficult one. It was a lengthy question, some technical requirement in relation to loss relief, and a lot of clerical workings in which you had to calculate the post-tax income, these IHT workings, a lot of clerical workings. The first requirement of ethics was an easy one, if you remember my handout of ethics. Then this working of CGT, it was very easy as far as you are good at the knowledge of gift reliefs and all. Then post-tax income, a lot of basic level working. Then loss relief one was a difficult one. I would say here a student should be good at loss relief plannings. That was an easy requirement. IHT was also an easy requirement with a basic knowledge requirement that you should be good at these basic calculations. So with this, our question number one of December 2024 exam attempt is done. Now in the next class, we'll be moving towards question two and then obviously towards question number three and so on. We'll be continuing our series of past paper discussion sessions. I hope that this class must have added value to your preparation in the last one. You have to use the summary notes for revision. These summary notes are really a life-saving document. You can contact me on my WhatsApp number if you need any sort of support, any guidance which you need. Okay? So hope to see you all in the next class when we will be discussing question 2 and then question 3 of this exam paper. Thank you everyone.